I was reading a book last night on investing, and it was written by a very successful founder of a hedge fund. And he basically was saying that they approach investing different than most people, in that what they're trying to do is minimize risk. And that is to say, buy stocks that have opportunity to grow, but minimize the risk involved. And he related it to the PE ratio. He said, in essence, what you're saying when you look at a PE ratio is that you are paying that ratio times the current earnings. So if a stock's earnings are $5 a share and the stock sells for $100, you have a PE ratio of 20. So you are paying for the next 20 years of earnings when you pay $100 a share. And he said that's putting a lot of risk, because a lot of things can happen over the next 20 years. So he said, in essence, the less riskiest stock is the stock who has the lowest PE ratio. And I looked at it and I thought, well, yeah, but why does it have a low PE ratio? Because there is not a lot of faith in the market that this stock has much growth opportunity, because the market is very efficient. We must recognize that they are telling us on a day-to-day, minute-to-minute basis what the value of a stock is based on its current and its future earnings. So if it has a PE ratio of 400, it's a very risky stock, because to get the price back, you're going to have to accumulate 400 years of earnings, okay? But on the other hand, if a stock's PE ratio is 5.63, that means that the earnings it generates will equal that price in 5.63 years. Are there stocks with PE ratios of 5.63 in the S&P 500? Yes, there are. Are there stocks, on the other hand, that have PE ratios of 440.38? Yes, there are. And they are stocks that are pumped or spoken very highly of because they anticipate that this stock is going to take off. But what he's saying is there's a whole lot more risk in that 440 PE ratio stock than there is in the 500 or 5.63 stock. So what I did was I said, okay, I'm going to take the 42 stocks that I follow, and I'm going to rank them based on their PE ratio. And then I'm also going to put in their PEG ratio, and I'm going to see where's the risk and where is the safety. So let's go to the computer. I think you'll find this interesting. I did, and I thought it was quite enlightening. And then what I thought was, okay, let's throw the dividend in there as well and see if some of the high-risk stocks have dividends, or is it the low-risk stocks that have a dividend? And when I say low risk, it's relative to PE ratio. I'll show you. Okay, here's the spreadsheet I created this morning that gives me a breakdown on the risk associated with the stocks that I follow and some others that I took off of the S&P 500 just to give some reference points. So how I've ranked them is relative to their PE ratio. Now, these first several stocks that I've shown in green have no PE ratio because they don't make any money. This is Symbotics, this is Applied Digital, this is Navitas, that's SoundHound. And then these are some that I've picked up that I do follow, but some that I don't, such as this is General Motors, United Airlines, CVS Healthcare, a Ford Motor Company, and then some others that they do, and then Verizon. I put in Verizon too, because I wanted to get some stocks that had the low PE ratios. And let me just take this through because it's kind of interesting. General Motors is a $56 billion company that has a PE ratio of 5.6. That's saying, based on their earnings of current, that you will have to wait 5.6 years of earnings to justify their current price of $51.55. Now, on the other hand, you have CrowdStrike. CrowdStrike is selling for $310. It has a PE ratio of 440.38, meaning that you will have to wait 440 years at their current earnings ratio to justify the $310. Pretty crazy. Let's take another one that I thought was interesting. This is Palantir. There are a lot of people who think this is a stock given to us from God, and they're $100 billion company, and their PE ratio is 264.45. So that means you're going to have to wait 264 years of their earnings to justify their price of $44.85. Huh. That means they're a high-risk stock because in 246 years, a lot of things can happen. But on the other hand, in General Motors' case, $56 billion company, Palantir is a, what did we say? A 100 billion. So I didn't realize that, but it looks like Palantir has a market cap, I guess that would be okay, right, of twice the size of General Motors. That's interesting. But nonetheless, it has a PE ratio here at General Motors of 5.6. And I wanted to compare that just for sake of argument. Here is Ford. Ford has a PE ratio of 11.9, we'll call it 12 years of earnings to justify their price of $10.35. And it's a $41 billion company. Now, the other thing I thought was interesting, because I knew Ford paid a pretty hefty dividend, 6.86%. So what that says is the price could stay at $10.35 for the next 11 years, and I'd still get paid $6 or 6.86% on my investment. That's interesting. General Motors, I'd get paid just less than 1% per year, and on Palantir, I'd get paid nothing. Huh. Okay, some interesting numbers there. And then what I did was say, okay, the green are, they have no earnings, so they don't have a PE ratio. The light brown run from 5.6 to 17.8. And as I say, you have some companies that I believe have some real growth potential. ACLS is in the semiconductor world, but it's a small company. Compared to Ford Motor Company and Palantir. Its market cap is quite small, but its risk level is relatively small, a PE ratio of 12.42. When I look at some other companies in the semiconductor space, such as Rambus, they're at 27. Microsoft is not a semiconductor, but they're 36. So I need to weigh into my calculation risk. Do I believe that Microsoft is going to give me some good gains over the next 36 years? I do. They have over the last 20. Let's look at Apple. They have given us some tremendous earnings or growth. They're a $3 trillion company. Their PE ratio is 35.5. Their PEG ratio, on the other hand, is 3.45. And your PEG ratio basically tells me that what is the likelihood that the price is overstocked at its current price of $233. That is saying that Apple is overpriced relative to Google, who has a PEG ratio of 1.3. And so it is somewhat underpriced or better priced than that of Microsoft. And then here's SMCI, Supermicro computers, macro computers, they're a 0.3, and we know they took a hit because of some poor filings of papers, and so they have a PEG ratio of 3, which makes them very attractive, and they have a PE ratio of 24, so they look quite attractive. What this does is basically opens some I don't know, a different look at risk. Again, let's go down to the bottom down here where we have some companies we're very familiar with. Here's Broadcom, AVGO, a $800 billion company, but its PE ratio is 139 and its PEG ratio is 1.82. So these are just things that can help us make good decisions. Let's look at Tesla, $800 billion company, a PE ratio of 72. So based on their current earnings, it's going to take 72 years to justify the price of $255.99. But I just put into my equation that, and then look at its PEG ratio, very, very high. But then you have so many other elements that are involved in Tesla beyond, let's compare car companies to car companies. Tesla has a PE ratio of 72, let's call it, and a PEG ratio of 6.7, whereas General Motors has a 5.63 and a PEG ratio of 1.9. Ford Motor Company, again in the same industry, again, Tesla was 77, wasn't it? Tesla. There it is, 70, call it 72 PE ratio. General Motors 5.6 and Ford 11 point, and they're in the same industry, but they're not, okay? Ford just gave its earnings today, and they were extremely disappointing. So this is a different way to look at stocks. I'll share this with you on my website. I'll put it down by the cheat sheet. I'll leave it there for a couple of weeks, but I don't think I want to. I don't want to be constantly having to update it, because a lot of these numbers I have to go dig and find, because Samantha is not totally up and running yet. So this is how I look at stocks. I just thought it was interesting listening to this investor of a very successful hedge fund and coming away based on what he told me, in that his number one pick would be Ford Motor Company with a dividend of 6.8, and probably Verizon, a dividend of 6.5 and a PE ratio of 17.8 and 11.9. In essence, what he's saying, these are substantial companies and they're not going anywhere, and they are priced very conservatively, and you've got a dividend of over 6% in both cases. So the worst you potentially can do, because we don't believe they're going to go out of business, is make 6.8 or 6.5% per year in dividend, unless they lower their dividend. Okay? So that was my takeaway. Kind of eye-opening, and I wanted to share it with you. So if you want to dig into this deeper, come look on the Kerry's cheat sheet, and you'll find it in there. Just page down, and I'll paste it in there. So, but it'll be static. This is not going to be a live spreadsheet like some of the others. Very interesting and very enlightening. And again, I want to share with you, this is from my readings. Read this book, said, I need to share that because it's different than what the way I have looked at stocks in the past. Kerry Grinkmeimer, retired financial advisor. I do this because I love it. I learned so much this morning, and I just had to share it with you. Talk to you again tomorrow, probably.